Okay. Hello, my friends. Um, Today I would like to make a short presentation about retail investors in the bond market and the regulation 144A. But before giving you the presentation, I would like to talk a little about my experience and about myself. My profession and my job is not retail investing. It's not buying bonds and stocks and shares or mutual funds or ETFs. No, I have been doing this as a hobby for the past maybe 30 years. This is just my hobby. And I used to have a bank account in Germany, and in Europe the rules and regulations are a little bit more different, which means that over there in those years when I started, they were I was able to buy bonds and stocks as I pleased and as I chose, and therefore it was very easy. I used to buy US corporate bonds and did my own research, and everything was very well until about maybe 7 years ago. Things started to change. My bank in Germany, where I used to live at the time, told me that I have to either close my account or give my money to them so that they manage my money, which means that I was no longer able to buy the bonds that I used to find and to give my bank the instructions to buy it for me. So this is how it started. And then I moved to the US and opened accounts here, and I thought that it is different. Now I can buy any bonds that I wanted, and any bonds that I wanted to buy, rather than the banker or my advisor telling me what is a suitable one for me or what is not suitable. Having said that, I always go to the site FINRA, and when I go to the site FINRA, I find I search and I find the bonds that I like to buy with a good rating as well as good yield. But lately I discovered that no, there are some bonds that have good yields and have good ratings, but I am not able to buy. I'm not able to buy it because of Regulation 144A. Regulation 144A states that only certain group of people can buy some bonds, and I am not simply qualified for buying bonds, those bonds. So, in order to make you better understand what regulation 144A is, I'm going to give you this presentation. So, you look at this CF, and then I will try to read this for you. Rule 144A, Securities Act of 1933. Well, actually Rule 144A did not exist back in 1933. It has some restrictions, and I will explain to you later what these restrictions are. But basically they can be either sold to institutions, it means institutional investors, or to qualified institutional buyers. And I will explain to you the difference between qualified institutional buyers and institutional investors. Rule 144A modifies restrictions for the purchase and sale of privately placed securities among qualified institutional buyer without the need for SEC registrations. According to the rule, sophisticated institutional investors can buy it. What is Rule 144A bond? It is a relatively new security gaining popularity. Who is a qualified institutional buyer? In United States, law and finance is a purchaser of securities that is deemed financially sophisticated and is legally recognized by securities market regulators to need less protection from issuers than most public investors. Typically, the qualifications for this designation are based on the investor's total asset under management and specific legal conditions in the country where the fund is located. Rule 144A requires an institution to manage at least $100 million in securities from issuers not affiliated with the institution to be considered a qualified institutional buyer. Okay, this is important. An institutional investor is an entity which pools money to purchase securities, real property, and other investment assets or originate loans. Institutional investors include commercial banks, central banks, credit unions, government-linked companies, insurers, pension funds, sovereign wealth funds, charities, hedge funds, REITs, investment advisors, endowments, and mutual funds. Operating companies which invest excess capital in these types of assets may also be included in the term. Okay. we are going to talk about institutional investors. What is an institutional investor? As I mentioned earlier, insurance companies, pension funds, hedge funds, investment advisors, university endowments, private equity funds, mutual funds, and the banks. So in here you can see, but the most important ones are the mutual funds, and insurance companies come second, and perhaps the private equity funds, hedge funds, and the banks. The others are less important here. So now we know who the institutional investors can be. Usually these institutions have large sums of money available. Here in this table, you see that the fund management institutions, they handle about $5 billion of securities assets. Insurance companies, about also $5 billion. Securities companies, about $10 billion. Commercial banks, about $10 billion. And other institutional investors, pension funds, trust companies, charitable foundations, donation foundations, and government invested institutions, about $5 billion. So the securities assets under management are these amounts that I just mentioned, and they usually have more than 5 or 30 years of experience. I give you examples of some retail and commercial banks. In China, ICBC, in UK, HSBC, in Japan, Mitsubishi, in Germany, Deutsche Bank, in France, Crédit Agricole. Investment banks like JP Morgan's in USA, Goldman Sachs, Morgan Stanley, Bank of Merrill Lynch, Citigroup. And for the asset management companies, BlackRock Incorporated, Vanguard Group, Allianz Group, State Street Global Advisors, Fidelity Investments, pension funds like the government pension investment in Japan, and so on. You can see that the size of the money that they are holding and they are managing are in that table over there. Nowadays, if we want to trade bonds, we have to go to these institutions. Now, what is the difference between institutional investor and retail investor? Institutional investors manage other people's money, whereas retail investors, they manage their own money. Institutional investors trade more frequently, whereas retail investors trade less frequently. Institutional investors deal with large amounts of money that has the ability to affect the stock market, whereas the retail investors invest relatively small amounts. Institutional investors' brokerage fees are less, as are trading more frequently with bigger amounts, whereas retail investors' brokerage fees and commission fees are high. Institutional investors specialize knowledge, research, and available resources, whereas retail investors, they have fewer skills and knowledge. Institutional investors have access to any information available on the market, whereas the retail investors, they don't have that type of access. So, criticism of Rule 144A. Rule 144A succeeded in increasing non-SEC trading activity. This led to concern over trading that was all but invisible to individual investors as well as some institutional ones. The Financial Industry Regulatory Authority, or FINRA, began to report Rule 144A trades in corporate debt market in 2014 in order to bring more transparency to the market. You see, in 2014, this is the time I stopped. In Germany, they stopped me from choosing my own bonds, and they said that if I want specific bonds, they have to manage my money as mutual funds. And then I decided that no, I want to handle and manage my own money, and I want to invest in the bonds. For non-reporting companies, basic information regarding the company, such as company name and the nature of its business, must be publicly available. Rule 144A provides a mechanism for the sale of securities that are privately placed to the hand of qualified institutional buyers that do. Okay, what is Regs and 144A? Reg S and Rule 144A bonds are types of bonds allowing the issuer to issue these securities without the need to register them under the Securities Act of 1933. The Reg S bond type is available for offers and trades of securities outside of the USA to US and non-US qualified institutional qualified investors, buyers. Again, the term Rule 144A refers to a legal provision that amends restrictions placed on trades of privately placed securities. This safe harbor loosens restrictions set forth by Rule 144A under Section 5 of the Securities Act of 1933, required for sales of securities by the Securities and Exchange Commission, SEC. Then again, I'm trying to point out here that there is some type of bias. There is discrimination between the institutional buyers and retail investors. Institutional investors have their hands are more open, they have more choice, whereas retail investors such as me, even though I may have information and even though I should have the freedom to choose whatever bonds that I want, unfortunately Rule 144A makes my hand tied and gives me less power and takes my the choices away from me. I am still able to buy bonds, but not any bond, only the bonds that are excluded from Rule 144A, which normally it is saved. It means that the better bonds, the higher yield from which have better ratings can be found somewhere. As you can see here in this table, and if you look on the top right hand side, you see SEC Rule 144A, and here you see that it is paying high coupon rate. You see the maturity date up there, and funny enough, this particular bond here, it is not I cannot buy this. Or any bond, if I go to the FINRA table, if I go to the search in the FINRA bond section, SEC Rule 144A makes a limitation here, but if you look on the right hand side, right hand top, you don't see that 144A. I can buy this particular one. It doesn't mention up there Rule 144A. And this one, although the coupon rate is very good, but it is the Moody's rating is CAA1, and the Standard Poor's rating is CCC+. So even though this is more of a junk type of bond, it is offered to the retail investors, and it is also offered to the institutional investors. But here is another kind of discrimination. This bond is, again, as you can see on the top right hand side, is SEC Rule 144A, and the rating was B by Moody's and by Standard Poor's. Here with this bond, the rating is CAA and B-, and it is offered both to retail investors and institutional investors. Okay, again, retail investors, small volumes, less control over the market, less research in decisions, less liquidity, free form regulation. Institutional investors, large volumes, market maker, can move the market, it trades, they can make it go up, down. They have a research team, low liquidity, hard to buy and sell positions, forced to disclose info to Securities Exchange Commission. Again, I belong to this retail investor group, and I think I have the right, and I should be able to. It is my money. I can buy anything I want, but there is discrimination. I am forced to go and buy this type of bonds here with very low yield, whereas if I want to buy the same type of bonds in AAA rating or BBB rating, which have higher yields, I cannot buy those. Only institutional and qualified investors can buy those. So this is another discrimination here. I'm trying to tell you that Rule 144A is discriminating between the retail investors, and is more favorable to the institutional investors. Now, in order to better understand how the institutional investors trade these bonds, we have to understand mutual funds. A mutual fund is an open-end, professionally managed investment fund that pools money from many investors to purchase securities. Mutual funds are the largest proportion of equity of U.S. corporations. Mutual fund investors may be retail or institutional in nature. The term is typically used in the United States, Canada, and India, while similar structures across the globe include the SICAV in Europe. In France, they have SICAV, investment company with variable amounts. In the United States, closed-end funds remained more popular than open-end funds throughout the 1920s. In 1929, open-end funds accounted for only 5% of the industry's $27 billion in total assets. After the Wall Street crash of 1929, the United States Congress passed a series of acts regulating the securities markets in general and mutual funds in particular. I believe that when this act was passed in the Congress, it was very unfair, it was very biased, because as you saw in the previous table, you saw that triple A and triple B and triple C type of bonds, but where the retail investors had the choice only to buy lower yield bonds, the institutional buyers had the choice to buy also the higher yield bonds. So here what is happening is that the retail investors are pushed into the hands of institutional buyers, so that if they want to buy certain bonds that are included in 144A, they should either go through, they can only buy through mutual funds. Okay, here you can see the history of these mutual funds and how it started. As I mentioned, it started after the Wall Street crash of 1929. And later we will see that later on we will see that these mutual funds, how they work actually, and who owns and who manages which amount. Beginning in the 1980s, the mutual fund industry began a period of growth that has continued largely uninterrupted through the present day. For instance, global mutual fund assets have increased in every year since 2003, except for 2008 and 2011, which, as you see, until late 1990s, even early 2000, the retail investors had access to all types of bonds. And then after the 2000, it was different. Here in this graph, you will see what I mean. In 2004, these are high yield face value 144A bonds. You see their numbers have increased from 2004 till 2020, whereas here you see the non-144A high yield face value bonds. You see here the number at this point in 2018 is decreasing, whereas the number of non-1448 is increasing. It means that more and more mutual funds are getting their hands on the 144A type of bonds. Here you can see 7 types of mutual funds. Money market funds. These funds invest in short-term fixed income securities such as government bonds, treasury bills, bankers' acceptance, commercial paper and certificates of deposits, and corporate bonds, and so on. Fixed income funds, equity funds, balanced funds, index funds, specialty funds, fund of funds. These are the 7 common types of mutual funds. Again, I'm trying to tell you that those better type of bonds, those which have more value in terms of better yields and also better graded, either AAA, BBB, with higher yields, can only be found in the mutual funds package. You cannot find in the mutual funds package you can also find non-144A type of bonds, but you can also find 144A type of bonds. Whereas the retail investors, if they want to go and buy the bonds, they have to they can only buy non-144A. Again, this is, in my opinion, it is very biased, and I feel being left out. And I think that many other people feel the same. Many other people who want to have access to 144A bonds, but they are not able to do that. In the United States, mutual funds play an important role in U.S. household finances. At the end of 2019, 23% of household financial assets were held in mutual funds. Their role in retirement savings was even more significant, since mutual funds accounted for roughly half of the assets in individual retirement accounts and other similar retirement plans. In total, mutual funds are like that. How do they work? When it comes to mutual funds, you can make money in 3 possible ways: income earned from dividends on stocks and interest on bonds. A mutual fund pays out nearly all of the net income it receives over the year in the form of distribution and an increase in the price of securities called a capital gain. So little by little, I'm trying to tell you how mutual funds work. In my case, I am interested in bonds. I can only tell you this. Mutual funds usually are actively managed to buy or sell assets within the fund in an attempt to beat the market and help investors' profit. ETFs are mostly passively managed as they typically track a specific market index. They can be bought and sold like stocks. Again, in my case, I'm trying to tell you that I want to buy any type of bonds that I want, whether it is 144A grade or whether it is not. But unfortunately, I cannot. This is what I am trying to tell you. It's a discrimination. Okay, mutual funds today. At the end of 2019, mutual fund assets worldwide were $54.9 trillion, according to the Investment Company Institute. The countries with the largest mutual fund industries are United States, $26.7 trillion, Australia, $5.3 trillion, okay? And here are the name of some of these companies. BlackRock Group, who manages $9 trillion, Vanguard, $7.2 trillion, Fidelity, $3.7 trillion, PIMCO Alliance, $2.89 trillion, JP Morgan, $2.88 trillion, Prudential Investment, 1.7, and Bank of America, Merrill Lynch, $1.4 trillion. So if I'm a customer of Fidelity and Bank of America, Merrill Lynch, and I ask them, I want such a bond, and they say that we have to look in our stock to see whether it is available or it's not available. And this is again the better ones, the better quality bonds are always in their hands, whereas if I want to buy the bonds, the less the junk ones, the less favorable ones are available to people like me, who are retail investors and who have the right to do whatever they want with their money. I have the right to buy the Porsche or Ferrari as any other person if I have the money. I think it is unfair that only institutional buyers and qualified buyers can buy Porsche and Ferrari or Lamborghini. I should also be, I have the right to also buy anything I want. If I want to buy bad quality bonds, I should be able to. And okay, I think our presentation here is at the end, and I have made my point. My point is that we cannot buy whatever we want, whereas other people, other institutions, institutional buyers, they can buy whatever they want. And I want to ask you a question. Do you think it's fair? You can buy anything you want with your money. If I want to risk it, I should be able to. If I want to gamble it, I should be able to. And this is not right, that only certain group of people can gamble or can buy whatever they want. I want to know what your opinion is about this. Thank you.